Hello friends, in last video part 1 on the break-even analysis, what is the meaning of break-even analysis and how to construct the break-even analysis chart or cost volume profit graph and how to get the BEP. BEP means what? Break-even point that will be generated on this graph through this line which will intersect. This is the variable cost, this is the total cost line, and the line which is drawn for the sales line or revenue line. So it intersect, that point is called a break-even point. And also in this video we'll watch the margin of safety and selling price, how to compute algebraically. In last lecture, part 1, we can get the value of BEP graphically. In this lecture, we can see algebraically how to calculate the BEP. So welcome to my YouTube channel, Kadan Academy. We'll start with this graph. Here, the break-even point shown by this red arrow. This is the line of the total cost and the sale line, which will intersect, that will give the break-even point. And this graph is shown to you with x-axis the quantity produced or sold in tons, on y-axis the cost or the revenue generated in rupees or dollars. This break-even analysis we can study by using this chart, by drawing the fixed line, fixed cost overheads, after that variable overheads, that is total cost, and the profit. These profit will get this sale line, and how the sales goes on increasing, that profit will be goes on increasing. Friends, we have studied this profit zone is there shown to you, and this is the loss area in last video, and margin of safety, that is the actual sale minus break-even point sale, that is the point A. This sales up to this break-even point in units, that is minus actual sale, this is point B. So that is the margin of safety, that will be better to get the good for the business. So start with the how to compute the BEP. This break-even analysis is a tool that will determine the total revenue cost plus expenses, where the BEP point is there. That point is nothing but the business neither in loss or not in profit. So BEP is the point that will be very helpful to take a decision for the managerial planning or the take a decision for the future one. So that will to compute, how to compute. There are 3 methods of the break-even point you can compute. How to compute? First one is the unit sale volume, number of units based on the BEP you can calculate, or in terms of the money value or percentage estimated capacity. Starting with the first unit sale or the volume of the produce or the sale of the volume. How to calculate this break-even point? We can calculate by using this formula, fixed cost upon contribution margin per unit. This cost in rupees and margin, contribution margin per unit, that is rupees per units. So that rupees get cancelled, the per unit will be nothing but the units. So break-even point in units we can calculate by using this formula. So this contribution margin per unit we can also calculate by using the selling price per unit minus variable cost per unit. So this is the formula to get the BEP in volume or units of sale. So this break-even point in unit we can calculate fixed cost upon contribution per unit, that is F by S for the sales price per unit minus V is cost per unit, that S minus V in units. Now we'll go for the break-even point computed in terms of money value, that is the value in rupees, break-even point in rupees. How to find out? Break-even point in sales value or in rupees, you can find out by using the formula fixed cost upon P by V ratio. That is the profit volume ratio. This profit volume ratio, P by V ratio, you can calculate this contribution of margin upon sales price per unit. This sales price per unit, how to calculate this sales price per unit? That is the fixed cost into total revenue upon this unit sales price minus variable cost per unit. You can calculate this sales price per unit. But how to calculate the revenue? This revenue also can calculate by using the all the cost, adding this cost. So friends, the BEP in sales value in rupees, how to calculate? The fixed cost into S, that is the by S minus V, that is the P-V ratio. That S is the contribution upon the sales price per unit. S minus V upon sales price. Yes. Okay. This is the P by V ratio. So next, third point, the BEP computed in terms of the percentage estimated capacity. So this we can find out by using this formula BEP in percentage, the fixed cost into 100 upon gross contribution margin. So here gross contribution margin, what is the difference in? So gross contribution margin is what? Total revenue generated minus total variable cost. Total per unit, it's not a per unit cost, it's a total variable cost which is minus from the total revenue. So how to calculate the revenue? Revenue can calculate total revenue, income from sales of good, or in service industry, income from the service, into inside the bracket the quantity into price. So that is the calculation for the revenue. And this BEP in percentage, we can calculate F into 100 upon R for the revenue minus V. That means the gross contribution margin, this total revenue minus total variable cost. The total variable cost we can also calculate. For this, you can watch the video elements of cost. Dear friends, the fixed cost is what? All costs which do not change with the change in output. Whatever the output is increasing in whatever the volumes, that means like rent is not changed, interest charges, these are the example for the fixed cost. Similarly, variable costs, all costs which will change with change in output, means volume is increased, the cost will be increased. Like material is required more, so cost, variable cost also required more. Like fuel, power, labor costs, etc. are come under the variable cost. The total cost is then fixed cost plus variable cost. The selling price, how to calculate the selling price? Total cost plus profit. So we'll get the selling price. The revenue, income from sales of goods inside the bracket, quantity into price. So friends, what is the sale price per unit? So fixed cost into total revenue upon unit sales price minus variable cost per unit. So we'll get the sales price per unit. So this is a graph for the break-even analysis chart to calculate the break-even point. So here the two terms are there, margin of safety and the angle of incidence. These are the very beneficial concept to clear you. This margin of safety represent amount by which the volume of sales exceed one at a break-even point. This is the break-even point where there is no loss and no profit. Above this, whatever the sale, under this from 15 to 25, see here, this is margin of safety. That is the what, this is the difference between the actual sales here minus the sales of BEP, or this we can say the sale at BEP is at point A. This value is the difference between this 25 minus, suppose this is a 12, so that will be your margin of safety. So this reasonable level of margin of safety should be there. Otherwise, what will happen? Reduced level of activity may prove disastrous and even danger to your business, existence of business. So margin of safety must be there in your business. Horizontal distance between this break-even point output and the current level of output. This is the current level of output and this break-even level of the output. So that difference, nothing but the margin of safety. It may be expressed in terms of units or in terms of values, sales value, or as a percentage of the original budget. So that we can calculate by different way. So this gross contribution margin also we can calculate the total revenue minus total variable cost, margin of safety, actual sales minus sales at BEP. That is the break-even point. The margin of safety also can calculate by using this operating profit upon gross contribution margin. Or this operating profit, how to calculate? The total revenue minus total fixed cost minus total variable cost. That means what? This is the total cost. The gross contribution margin means what? Total revenue minus fixed costs. So this total revenue minus total variable cost will get the gross contribution margin minus total fixed cost, which will the operating profit. So these are the formulas to calculate this margin of safety with the different values are given in the numerical. So we can calculate this margin of safety. Whatever the data you have, from the data we can calculate these values, margin of safety. So dear friends, this is a very conceptual problem. And here angle of incidence, this point I want to clear you. What is the purpose of to calculate the angle of incidence? This is nothing but the angle at which the total cost line, see here, this is the total cost line and this sale line, when they intersect at this point, they break even point, and the angle made through these two lines is nothing but the angle of incidence. And this angle of incidence, very interesting point. This another on this graph, if larger the angle, larger the profit. If lower the angle, lower the profit. So this is the profit zone. You can see here in the green color it is written, and this is the profit zone here, and this is the loss area or loss zone, we can say. Below this BEP there is a loss will start. So avoid this, we have to increase the angle of incidence. How to increase this angle of incidence? That means we have to maximum the profit. For this was the part 3 video for the maximum profit. What is the use of this break-even analysis? Here first use, measure the profit and loss as the different level of production and different level of sales. At that production, what is the loss or profit, we can calculate by using this one. Or also we can calculate this, predict the effect of changes in price of sales. If price of sales is changed, what will the effect on the business? We can predict the sales required to reach the desired revenue. Whatever the revenue is were generated, or that will be correct or not, that we can also predict one. Okay, so now we'll see what is the use. They predict the profits at certain price level or the cost of the sales and efficiency. We can predict the effect on the profitability. Now we can see the various application we can apply to new product decision that will enable us to determine sale volume, how much sale volume is required for a firm or an individual product to break even point. Given expected sale price and the expected cost, we can get it for the new product or new business. Okay, this is one of the application. The pricing decision enables to study the effect of changing price and the volume relationship of the total profits. That also we can get it from this break-even analysis or the chart. The modernization or automation decision also we can take it from this analysis of profit implication. Modernization on automation programs we can start. Expansion decision also we can start. Study the aggregate effect of the general expansion in production and sales we can take it. So friends, lastly, what is the purpose of business? हम लोग business, what is the purpose? We have to maximize the profit. Maximum profit will get it. This maximum profit at full capacity. So for this, you watch the part 3 video to get how to maximum the profit at full capacity with a different case study. So friends, thank you for watching my video. If you are not subscribed my channel, please subscribe it. Thank you.